Hey guys, our stock portfolio is literally at an all-time high right now, and I'm really happy, but I'm also a little worried, which is why I just bought $300 worth of this one stock. Literally right before the recording, I bought $300 worth of this stock. So in this video, we're going to be going over my entire stock portfolio, my Robinhood accounts, taxable account, and my Roth IRA. I'll show you every stock that we got in here. I'll also share with you my dividend income because check this out. I had a recent change of strategy. This was way back in 2023. I used to own all the high yielding dividend stocks, but I've had a recent change of strategy and so far it's working out pretty good. We're already up nearly 11% year to date, which is just crazy. So we're going to be going over my entire Robinhood account as well as my Moo account. So in this portfolio, pretty much once I buy a stock in here, I'm never going to sell it, at least for 10 years pretty much. And if you go back to my channel like a year ago or ever since I started this portfolio, I haven't sold any stock in here. I've just kept on holding it. And this strategy works great for some holdings. Like check this out. Sometimes a big lesson can be letting your winners win. And like this stock right here has literally gone crazy the past couple of days, like an unbelievable rally. But you also got to be careful. Make sure you do your own research. Make sure you are buying into a high quality company because you never know what'll happen. Stay diversified and dollar cost average into the market is some of my best advice, but nothing in this video is financial advice. I'm just going to be sharing with you the good news of really, my stock portfolio is literally at an all-time high right now. So with that being said, let me share with you every stock that I own here in my Robinhood account. So here's all my stocks by total equity. My largest holdings are at the top, and I'll go ahead and show you my total percent change. So luckily we're up on every single holding in here, and this does not include the dividends. So actually every stock in this portfolio pays a dividend. But as you know, like Google, Meta, Salesforce, these all have pretty low dividend yields, but I believe the dividend growth will be very nice going into the future. And look at Constellation Energy right here. We're now up nearly 75% on this, and that's literally just from January 1st. Year to date, they're up 53%. This is the nuclear energy play that owns 55% of all USA nuclear energy facilities. And they just bought another company that's instantly accretive of $2 of yearly EPS. So that is insane. And ever since then, the multiples have just expanded. So I love Constellation Energy and I'm not taking any profit. Even though here in my Robinhood account, I'm allowed to take profits on stocks in here, I'm just not going to because I still think the valuation isn't nuts for them, but I'm certainly not buying at this valuation. But check this out. Here's McDonald's right here. And this is actually the stock I just bought. Literally today, I bought one share of this one right before the recording. And check this out. Yeah, we bought one share at $282. And we even bought like a fractional share down there. So I don't mind buying fractional shares of McDonald's. That's why we have like 11.35 shares. But we're only up 3.78% on our McDonald's shares now. And very shortly, I'm going to go into why I think McDonald's is such a good bet. If you don't know, McDonald's historically does great whenever there's a recession. They were the best performing stock in 2008 in the S&P 500. Like in 2008, there was no dip. If you look at any other stock in 2008, there was a huge dip. And, McDonald's is really a real estate company, and they move with the real estate investment trust. If we look at ticker symbol TLT, this is the reason why McDonald's stock has been so suppressed. It's because of the U.S. 20-year Treasury bond. Most of McDonald's market cap is their land value, their real estate value. So McDonald's is technically a mini REIT, and I love the dividends they pay. And here are the other stocks we got in here, like Salesforce, Google, Meta, and Zoetis. Zoetis was a recent buy that I had. We also have a $5 pending dividend coming in from Zoetis. So this is another fantastic dividend growth company. Literally 2 videos ago, I made a whole video dedicated to Zoetis. They will impress you. They are a stock buyback machine. They pretty much have a monopoly on the animal healthcare industry. They're the number one for so many different categories in the animal health sector. And they have an insanely low dividend payout ratio. So there's so much room to grow their dividend, and they do insane stock buybacks. But now let me go over my Moo account right here. So this right here, like I said, is my buy and pretty much never sell portfolio. And these are all the stocks we got in here. We got Powell Industries. This is an electrical manufacturer of like switchgear parts, which since they are an American manufacturer, they're about to get lower taxes because of the Trump cuts or whatever. And that's why ever since Trump's inauguration day, the stock has just been straight up, which is kind of cool. And we also got DocuSign. This is a debt-free company. This stock literally has zero debt. I actually have a watch list here of companies with zero debt. And again, just because they have zero debt doesn't mean they'll do good. Like look at Pinterest. Pinterest is the same price as they IPO'd at back in 2019. The stock hasn't moved, but all these other companies like Palantir, Yelp, Reddit, Duolingo, Zoom. These are all debt-free companies. Now, real quick, I know that we're going off topic here, but this is an extremely impressive company. This is Duolingo. It's that boring language learning app program on the App Store. But look, 81% of their business is a subscription revenue. Look at the growth here. It's literally up 50% year over year to a new record, as well as their advertising revenue. It's up 23%. In-app purchases up 1%. Anyway, and we look at the company's free cash flow right here. They make so much free cash flow. They make so much net income, and they're literally debt-free. So that's one stock I've kind of had on my watch list here, as well as Powell Industries. This is a completely debt-free company, and they have like 350 million of cash on hand, which is pretty cool. Another stock that I own is Disney right here. I've been dollar cost averaging into Disney. I'm buying this one for the exposure I get to the streaming business. They own ESPN, Hulu, Disney Plus. They just partnered with Fubo TV, which is kind of cool. They have 158 million premium paid subscribers. And just look at the FCF of this company, the free cash flow. They made $4 billion of free cash flow in the most recent quarter, up 17% year over year. So, and here's their operating profit right here. If you do a multiple on this, they're trading at a really fair valuation, actually. But if you scroll over to the net income, what's the huge difference here? These are some one-time adjustments that they have, which is suppressing their EPS. So if you look at their diluted normalized EPS, the valuation on Disney is very attractive. Also, look at oil right here. This is EOG Resources. I think it's okay to have a little bit of exposure to oil just in case inflation comes back or if there's war fears, because oil does good historically in both of those environments when there's inflation and war fears. And, you get the great dividend yield here. Like with EOG Resources, they have a 2.64% dividend yield and only a 25% payout ratio. So a very fair payout ratio. A little bit lower yield for a normal oil stock, but the growth there is phenomenal. Like, look, the stock is nearly at an all-time high pretty much. They also sometimes do special dividends. That's one of my favorite features about EOG Resources. Then we have Bill Holdings. This is a fintech right here. Actually, I don't know if I'd be buying this one after the rally. They just had this insane run up on some very, very nice earnings. And like if we look at their subscription and transaction revenue, look at this. It just keeps hitting a new record every quarter. It's up 18% year over year, growing a healthy double digits. And if we look at the free cash flow is up 69% year over year. So they just hit a record amount of free cash flow in the most recent quarter. So Bill's a cool one. Then we have CubeSmart. So now we're in the real estate investment trust. So CubeSmart is a self-storage REIT, and they have a 5% dividend yield. So this one pays me quite a bit of dividends, one of my highest payers because they have such a high yield. But they have such a high yield because they're a real estate investment trust. They actually have to pay out most of their income in the form of dividends by law. So I really like CubeSmart for the dividend here. You don't look at net income for REITs right here because you have to add back the depreciation and the amortization. So you really would want to look at the core FFO or something like the free cash flow here. Anyway, Cube, I really like them. And then there's Nike. Nike has fallen off a cliff because Nike lost their growth rate. Simple enough, Nike lost their growth, sort of like Celsius. So if we go over here and look at Nike's footwear revenue, their shoes, the shoe sales are down 11.4% year over year. So Nike really did lose their growth right here. And if we look at what the analysts are expecting, this is very not good. They're expecting 27 cents of EPS next quarter, which is very bad because the dividend cost 40 cents a quarter. So they literally won't be able to afford the dividend that quarter. But look at that. They usually beat on what the analysts are expecting. Like they expected 63 cents last quarter and they reported 78. So I'm sure they'll beat on that number. But I'm very worried for what's going to happen to Nike next quarter. So that's one I'd be very careful dollar cost averaging down into. And that reminds me of Celsius. Celsius I don't own. I don't have any exposure to. Oh, look at this. This app is telling me there's like some bearish continuation triangles. So that's not good for Celsius. But if you're wondering what has happened from Celsius, why'd they go from $93? Why'd they go from $95 all the way down to $25? That's because unfortunately Celsius lost their growth. Just look at their net income in the most recent quarter. It fell to just $6 million in the most recent quarter. And if we look at their total sales are down 31% year over year. So that's why I think it's so important to just take a quick look at the fundamentals and the financials because it usually explains why the stock price is done either so good or so bad. But there is some good news around Celsius, and this is why the risk to reward could be pretty decent right here. Celsius has literally no debt and 700 million of cash. So about 15-20% of their market cap is just the cash they have on hand. But keep in mind, they lost their growth rate. So that's really what investors are looking at. And then we have Perion Network down here, the last stock. And then I'm going to do some analysis on a McDonald's stock, why I think that one is a great bet specifically right now because bonds are so suppressed. But anyway, look at Perion Network right here. This is one of my biggest losers. This is why you don't listen to me. I'm not an expert. We just slowly dollar cost average into this one. The only bull thesis here, look at their market cap. They have a $421 million market cap, and they have no debt, literally no debt, and they have $383 million of cash. So they're pretty much trading at their cash value. But keep in mind, look what happened to their net income. This is when I was buying the company. I was like, look at these great numbers. They're making 20, 30, 40 million of net income a quarter. But look what just happened in the 2-3 most recent quarters. The net income even went negative last quarter, and the sales are down 45% year over year. That's because this company literally lost a contract with Microsoft, which is like the second or third biggest company in the entire world. So that's definitely not a great sign. Yeah, look at the free cash flow. It was only 11 million this quarter. So they really lost their growth, unfortunately. But yeah, I'd be so careful dollar cost averaging into that one. I like that they're trading at cash value though. All right, so what we're looking at here is the Real Estate Investment Trust ETF V&Q versus long-term bonds. I want to quickly show you that long-term bonds is what really moves real estate investment trusts. And they don't move the exact same, but they always rhyme together. That's why I would much rather buy a real estate investment trust than, just TLT itself. But as you can see, they pretty much rhyme together. When TLT falls, so do the REITs. But I want to show you one of my favorite REITs to buy. And this really technically isn't a REIT. Well, one of my favorite REITs is actually CubeSmart. I love Realty Income as well. But the one I'm talking about is actually, where is it? McDonald's right here. This right here is a mini real estate investment trust. And you can't complain about the 2.5% dividend yield. They're trading at a 25 PE ratio. So very fair valuation. And check this out. McDonald's is a share buyback machine. So look at their net income year over year. It is down 3%, but it is tough comparison because it was up 17% the previous year. But anyway, they made $2.26 billion of net income just in the most recent quarter. And what are they doing with that? Well, they only are spending $1.2 billion of that on their dividend. And the payout ratio is very fair. And if we look at their stock buybacks right here, they usually spend $1 billion every quarter buying back their own stock. And if you're wondering, why did they only spend $337 million in the most recent quarter? That was, last quarter when the stock was literally at all-time highs. And they just chose not to buy back that much stock that quarter, which I'm actually very okay with. So we can look at their EPS right here. We'll look at their dividend real quick. Their dividend is $1.77 per share. So the dividend cost $1.77, and the EPS, they made $3.13. Now the free cash flow per share was $3.81. So if you do a payout ratio based off their free cash flow, it's starting to look even better. But look at their diluted weighted average shares. They, with McDonald's, you get a 2.5% dividend, 1 to 2% in share buybacks. So you already have a near 5% total return just from them returning money to the shareholder through dividends and stock buybacks. And if we look at their diluted normalized EPS, they actually hit a record amount of EPS in the most recent quarter, $3.23. If you zoom out, it's never been above $3.23. So they actually just hit an all-time high record for earnings per share. So anyway, I like McDonald's because they're able to do stock buybacks. You also get a qualified dividend. McDonald's pays a qualified dividend. So me and my tax bracket, even though I own McDonald's in my taxable account, I literally pay 0% tax on it because I don't make that much money. Let me know what you think of my strategy of switching up from those insanely high dividend yielding stocks to what I think is a great portfolio of dividend growth companies, at least here in my Robinhood account. We also have our Moomoo account, which has some non-dividend paying stocks. But anyway, hope you guys enjoyed the video. Oh, did I forget to go over my Roth IRA? I think I might have. Well, if you made it to the end of the video, I really appreciate you. Here are my 2 stocks I own in my Roth IRA. I have BBW, which don't report me, stands for Build-A-Bear Workshop stock. We're actually up 8% on them. And here's my total return for my Roth IRA. We just started it, half a year ago. But yeah, I just try and put 20, 30 bucks every month into my Roth IRA. But yeah, I appreciate y'all. Hope you have a great rest of your day. And if you want, check out my video on Zoetis. I think this is a phenomenal dividend growth company. So anyway, hope you guys have a great rest of your day. My name is Nathan Robert.